So I'm here on air with Paul Mahoney from Nova Financial, and you were here with us July last year. Welcome back to the show.
I was, thanks for having me back.
You are no stranger to Property TV, and you gave us some really insightful predictions into where interest rates were going.
Yes.
Where are they at now? Were you right?
Yeah, so I think when we met last year, rates were at 0.5%, and I mentioned that it was likely they were going to come down to 25 basis points, and they did. That's resulted in lower borrowing costs across the board, really, which is probably likely to sort of continue for the foreseeable future.
So how have you seen that sort of knock-on effect, you know, in the buyer's market? What's been happening?
Well, the reduced borrowing costs obviously generally inspires more investment, inspires people to buy that previously couldn't afford to. But I think it's been kind of counteracted a little bit by some uncertainty in the market. Yeah. So one's kind of balanced the other out. I don't think there's been a huge effect of the reduction in interest rates, but I suppose that's the reason there was a reduction in the interest rates in the first place.
So where do you see the rates moving on from here?
Well, it's debatable, and different people have different opinions. However, when you look at historical rates and the way they've moved in the past, what tends to happen is they move in one general direction for a period of time. For example, for the past 8 years, they've either moved down or they've been flat. And then they tend to hit a plateau for a period of time. Monetary policy is a slow fix. So it takes a couple of years for a reduction or an increase in rates to really flow through the economy. So what tends to happen is they'll plateau for sort of 2 to 4 years, and then they'll move in the opposite direction. And I think that's what will happen here on in that rates will probably stay where they are for the next couple of years at least, as that flows through the economy, and then they'll likely increase from there. How much they increase by is anyone's guess. Obviously a lot changes in a couple of years, but the way that things are at the moment, I can't see them increasing anytime soon.
We look forward to seeing if your prediction's correct, as it certainly was last time. And have you, as an effect of this, have you seen any changes taking place in the market?
Well, there's been quite a few changes, especially associated with the buy-to-let market, which is where we specialise. The two major changes really is, well, three major changes, was firstly the way that mortgage interest is treated from a tax perspective, and that affects a range of different people in different ways. The second change was just in January this year, where the Bank of England mandated that buy-to-let lenders need to use a benchmark rate of 5.5%, and that needs to be covered 125% of the time. And then the third change with regards to a stamp duty premium. The first two changes I mentioned there are quite likely to impact low-yielding, high-value properties the most.
And where would you find these, maybe?
Well, predominantly London and the southeast. So those types of properties, it's going to be a lot more difficult to maintain the sort of age-old strategy of buying simply for growth in properties that are just sort of breaking even, because those properties may find themselves in a negative cash flow position given these two changes associated with costs and how much you can borrow.
Yes.
So, you know, for example, the outcome of that change, the way that lenders look at serviceability, is that now the maximum borrowings in London is often between 50 and 60%, depending on the property and the yield you're achieving. And then with the mortgage changes, the changes to mortgage interest, the way it's treated from a tax perspective, over the next 4 years, anybody who's earning more than £50,000 per annum is going to find their properties being less tax efficient.
Okay.
So, you know, that means that yield to support those two changes becomes more important.
So have you seen a change or a shift in where people are investing? We
have, yeah. Certainly over the past 12 months, the age-old sort of safe haven of London has shifted a lot. We deal with both investors in the UK and overseas, and most of that shift we've found has been to the northwest, places like Manchester and Liverpool, which are fairly substantial economic hubs in their own right, but offer lower value properties with higher yields in good areas, which is something that's become increasingly difficult in London and the southeast.
Absolutely. And what would be your suggestion for somebody who was looking into, you know, investing in a buy-to-let property for the first time in this market now?
It depends what their goals are and their financial position and what they're working toward. But in general, as I mentioned, yield is more important. Now, of course, generally you want a balance of rental yield and capital growth.
Right.
The vast majority of our clients have been investing in Manchester and Liverpool. Generally, the city centre or city surrounding areas with a lot of depth.
Okay.
What I mean by the depth is large tenant pools, a broad range of industries and therefore employment, areas where facilities, infrastructure and amenities tend to be more abundant. That attracts the right sort of people and results in stronger socioeconomic levels and lower vacancy rates. And all of that depth tends to mitigate risk.
Okay, and probably an increase in rental value as well if you're surrounded by them.
Yeah, exactly right. Because obviously when you're investing in property, you want it to be very easy to rent and very easy to sell at some point in the future, as well as it not just being attractive to investors, but also to owner-occupiers because they're half the resale market. So they're the types of things that we look for. We cover the whole of the country and it's really just about determining what works best for each individual.
Fantastic. Well, we very much look forward to having you on the show again in the future to let us know what's going on. And thank you for joining us.
Thanks very much for having me.
That was Paul Mahoney from Nova Financial.